Good evening to you all. Thank you for taking the time to be with us today, and thank you once again to the CFA for partnering with us to set up this call. Normally we would be doing this with you all live in person through a series of lunch roundtables as Erik and Joe have over many years visited the region in person at this time of year, but given the current circumstances, this is the next best thing. So hopefully we won't lose the benefits of hearing from Erik and Joe, and there is a lot to hear from at the moment with the way that the world is going. Also, just as a matter of quick update, a number of you I'm sure will know that this will be my last CFA call for the Middle East, as I've moved on to being in London. I'm now based in London, looking at a broader role, looking after official institutions for the firm. So I'm very pleased to hand over my Middle East responsibility to Kaveh Sami, who a number of you will know, as he has been in the region for the better part of 3 decades. And the last decade of which was leading KKR's business in the region. So we're super excited to have Kaveh on board to lead our Middle East business, and he and I and the rest of the team will look forward to working over the next few months for a smooth transition. So we're all here. You just have more people to deal with at Neuberger Berman. So hopefully that's positive progress, and we're super excited about the next phase of the journey for our Middle East business. I'm sure you all know by now, having met in person over the last few years, but if you don't, Erik Knutson has been with the firm for about 6 years. He's been on the other side as the CIO of a consulting firm and leads our multi-asset business based out of New York. Very unusual job relative to our peer groups, because he's not an economist, he's not a strategist, but the views that Erik shares with you today are those that are implemented in our portfolios, in our multi-asset portfolios, typically for our largest clients, but also more painfully for Erik, for our employees' deferred compensation fund as well. So his strategy is one that's looked at very closely, and one that is hugely differentiated in the marketplace, because it is much more practical, actionable set of investment decisions and ideas. So hopefully you'll enjoy that. Joe works with Erik, based in London, as our head of solutions, and huge amount of experience. He's been on the other side by running plans, having worked for IBM and Shell, and leading their pension plans. So again, a huge practitioner in the investment space, and I look forward to very interactive discussion with them today. So please do keep questions coming in throughout the course of it. I will take a couple of breaks to address your questions as they come in, but do please feel free and send them in on the Q&A section above. Just briefly, it's been an incredible year, right? I mean, here we are in the middle of September. On the one hand, it's just a disbelief that we're already in September, but at the same time, I think every single one of us can't wait to see the back of 2020. It's definitely been a year that all of us will remember from both personal and professional perspectives. And you know, navigating the market and the environment has been a fascinating activity. Nothing really changes from a firm perspective at Neuberger. As you know, we pride ourselves on our stability and our consistency. Being a private firm through environments like this has put us in an incredibly strong position. We have prioritized our employees and their well-being over everything else in this environment. Our chairman very aptly puts it, we were the first out of New York, and we have no intention to be the first back into New York, i.e. we are very keen to protect the safety of our employees and their families, and we have been working from home from somewhat early March. And while some of us are back in the office, working on a voluntary basis in our different offices, the firm has fared incredibly well over the last 6 months, and we feel no urgency, particularly in some of the bigger city centers like London, New York, Frankfurt, to encourage people to or to force people back in. Public transport remains a concern, and people's safety remains our primary concern. So whilst we are a firm that believes in human interaction and office culture, it's currently a balancing act. So for the foreseeable future, we will all have one too many Zooms in our daily lives. In every other form, the performance of the different strategies at Neuberger remain incredibly resilient. In fact, we've seen significant outperformance. As you can see from the slide I'm sharing with you, 97% of our fixed income strategies have outperformed their peer group. We continue to see good, strong activity in a number of different areas. Just jumping on to the platform, one of the things that you will remember earlier this year, we added on a large private real estate team and capability to bolster our public real estate capability that we've had. We've already had a very strong US and global REITs platform, and we bring on board the Almanac team, which provides us with a great on-the-ground capability in the United States to deliver niche real estate capability that, again, provides a fascinating alpha source. They have a somewhat 25-year track record, generating consistent 12 to 13% IRRs over that year on year. So a very, very strong track record, a differentiated strategy in the real estate space. Happy to share more details with any of you that are interested. I think one of the things that has made Neuberger incredibly resilient in environments like that we've been experiencing for the last 6 months is the diversity of our platform. We are blessed to have a number of specialist teams. We're across about 55 different capability sets now. So whether that's from our industry loss warrants or insurance-linked securities, all the way to more traditional global equities, US equity strategies, we have capabilities that are allowing us to feed those ideas from a bottom-up perspective into Joe and Erik that create the alpha sources both at an idiosyncratic level, at a single idea level, but also allow folks like Erik to create much more informed views from practitioners on the ground, providing us that insight. Give you an example, throughout this crisis, we have dedicated China equity teams, China fixed income teams on the ground, based in Shanghai. They had been providing us with very, very regular insight as to how the cases were evolving on the ground. That coupled with whether it's our Japanese equities team or our Singapore-based EMD team or our US-based fixed income teams, we were able to chart the journey of COVID and the way the unlocks and the governments were behaving. And we were able to use that a little bit to map how we thought the situation would unfold. With that, we created what we feel is called the investment playbook. How do we see different curves forming in different markets? How have different governments responded? How have different markets responded as a result of that? And on that note, I'd like to hand over to Erik to talk about how he and his team have been thinking about the next 6 months or the next year ahead of us in this environment. Erik, over to you.
Great. Thank you, Jahangir, and thank you all for joining us this evening. It's great to speak with you all, even if it's by Zoom. Normally, Joe and I would be in the region around this time. It's always around the September Fed meeting. to discuss both current market and economic environment as well as longer-term themes. And so last year we were meeting with a number of you over lunches in your local domiciles. This year, obviously by Zoom, but Joe and I hope to be back in the region, in the future, doing these meetings in person. I think it's much better when the interactions can happen that way. If you skip ahead to the crisis, as Jahangir mentioned, the next slide, we met as a group in March very regularly as we were going through this crisis. The senior investors across Neuberger Berman, our Asset Allocation Committee, and our multi-asset class team, almost multiple times a week, usually starting on Sunday and going through the week. And as part of that process, we built what we called our crisis playbook, and that was an effort to understand what was happening in this COVID crisis and the related shocks that were rippling through the global economy, including impact on commodities such as oil pricing, et cetera, to develop a set of potential paths that we felt were likely, we were likely to potentially go down as we worked our way through the crisis. And as part of that analysis, we identified a number of key themes where we felt strongly that we were entering a new investment regime, and the post-COVID world would be characterized by these key themes. We published that playbook in early April, and then policymakers and markets responded dramatically, and by July we had a lot more information, and so we updated our playbook and continue to revise and update that playbook. We had the chance to speak with some of you in late April to share those early insights, and now we get the chance to update you now that we're, depending on how you want to measure it, 6 to 9 months into this crisis. And the quick observations is that we are in the midst of the greatest global growth shock in more than 50 years, really since the Great Depression. That unprecedented policy responses have been taken, both fiscal and monetary policy responses, really globally. And that has led to a primarily liquidity-driven recovery in global markets. Now that we have seen the policy responses, or at least the outlines or the first waves of the policy responses, we've seen at least the beginning of the path of the virus, and now we're potentially seeing second and third wave effects, and we've seen the response of markets. We are working with our clients and evaluating a pretty challenging and interesting environment where we're balancing these responses and the information we now have with valuations that have been driven higher by the liquidity-driven response by markets. In terms of the paths that we articulated, we believe that the economic base case remains a more U-shaped recovery, a more gradual economic recovery. That's the economic path. Markets, however, have moved more like a V-shaped recovery. At least the market reaction has been more V-shaped. At the same time that, in our view, bear case L-shaped path outcomes still remain, and we see it with the increase in cases in the UK and Europe, risks in the US around geopolitics and the coming election. And so we still think these paths are relevant. We've updated them. We'll share with you our latest outlook on economics. And we still think the key themes we identified in April remain, that the importance of durable income and yield, a new way, the importance of a new way of thinking about equity investments, opportunities in taking advantage of dislocation, and the importance of idiosyncratic or non-market driven ideas to generate needed returns. All that said, the low-hanging fruit, as it were, associated with the sell-offs that we saw in February and March have largely been realized. So it's a more challenging or nuanced environment going forward from here. As we turn to the next slide, let's get into some of the details on this. just as an example of the policy response, we show here the kind of fiscal response we've seen. So on the left, this is fiscal response as a percent of GDP, and you can see that, in the developed world, U.S., Europe, Japan, we've seen 15 to 35 or 40% of GDP committed to addressing the impact of coronavirus, ranging from kind of direct spending to liquidity provision or support. And we also, that's on the left-hand side, so certainly we've seen unprecedented and probably appropriately so responses on the fiscal side. You add monetary response to this and it's magnified even more. On the right-hand side, though, when you look at the absolute dollar amounts, it does highlight just how much the U.S. can do given the size of the economy and how much of that is in direct support, which has probably contributed to the type of rebound we've seen in the U.S. But also that as you look to the right side of this, when you get to the emerging markets, they are able to do less from a percent of GDP, and those dollar numbers are smaller, which highlights some of the potential challenges as you move from the developed world response to the emerging world response, and why one of the contributors to why we are so biased towards developed market or Greater China opportunities as opposed to broader EM. On the next slide, we go through the paths, we show the path of the markets, and this highlights what we do here is we overlay the current performance of the U.S. stock market in this crisis versus the Great Financial Crisis and the Great Depression, and just see how fast the recovery has been. Now, this may be absolutely appropriate because this was an exogenous shock as opposed to a more systemic shock to markets, but given our economic outlook, it highlights that markets have certainly moved very rapidly relative to underlying economics. And so this shows that V-shaped recovery in markets. And yet, when we get back to our economic outlook, which we share on the next page, this is for the U.S., but we do this for Europe, Japan, and China. Our base case view, this middle path that we show here, remains a more gradual or U-shaped recovery. We have updated this, through 2021. We now know that the contraction in the first half of 2020 was more than 30%, but the recovery will be strong, but gradual relative to that decline. Now, our latest updated view is that we expect the U.S. GDP to decline 5% for the full year. So a rebound, but not a complete rebound, and then a 4% recovery next year. This implies that in our base case, the U.S. does not reach pre-crisis levels of economic activity until the first half of 2022. This path has become largely consensus, although the most recent information from the Fed, from Wall Street, is now upgrading the U.S. outlook for 2020, but decreasing the outlook for 2021. So the Fed's latest numbers from their meeting last week indicated that they expect the U.S. economy to decline 3.7% for 2020, but they haircut their 2021 forecast to get to about the same place. So from an economic activity standpoint, we still view this base case outcome with this gradual recovery as opposed to a true V-shaped recovery as the most likely outcome. Now, we also show our bull case path to recovery, well, we already know what the contraction is, but a more rapid recovery and a stronger growth so that we regain economic activity in the U.S., peak economic activity sometime in 2021. And we've actually increased the probability of that outcome, but at the same time, we've also increased our probability of the bear case, where we see more of this lingering slowdown. So even as our base case appears more consensus-oriented, we believe the uncertainty around economic outcomes is increasing, and this certainly informs our market views out of this. On the next slide, we share the information, a similar analysis for Europe, a little bit steeper of a initial contraction, a greater drawdown in 2020, but a more robust recovery in 2021, getting about back to the same place as the US by sometime in 2022. Now, when you compare this path to markets, there has not been as strong or complete a recovery in markets. So even though our economic path for Europe is perhaps not as strong as in the US, we observe that they have been ahead of the US up until recently in terms of the path of the virus and containing the virus. And we see some more interesting market opportunities in Europe, and that informs some of our views. But as much as we now have this information about the path of the virus, lockdown and reopening, fiscal and monetary stimulus, and the initial signs of the rebound, there is still a great deal of uncertainty. And I think that is the most important thing to bear in mind as we think about the next few months in markets and try and translate that into our key themes. And as you dig down beneath this economic information and look at some of the data, whether standard data or big data, non-traditional data sources, I think that highlights this level of uncertainty. So as you go to the next slide, we just provide additional detail. Here we're looking at on the top, the path of reopenings in Europe. Now, mobility in many markets has almost reached pre-crisis levels, but you can see on the right-hand side that it's really flatlined over the recent years. It has not fully regained pre-crisis levels. And now with the UK, rate of infections going up, other economies experiencing rise in infections, potential for additional restriction measures in the UK, we are more cautious in the short term in terms of kind of declaring victory on containing the virus. In the US, despite a lot of really difficult headlines through the summer wave in the south of the US, you see more positive recent trends with case growth, hospitalizations, and deaths all declining. And over the weekend, the major projection group IHME reduced their expected death count for 2020 by about 35,000. Still all tragic, of course, but you see some of the improvement in trends in the U.S. You also see, from a big data standpoint, the improvement in, say, open table seating on the right. It's improving, but it still hasn't reached prior levels. Turn to the next slide, and you see the contrast with China, which has in many ways been able to almost fully reopen and regain prior levels. Jahangir mentioned our deep capabilities in China and resources on the ground. This has both given us an edge in terms of gaining insight into activities there and kind of the front line and path of the virus, but it's also represented one of our better investment opportunities that we've seen as a way to add risk to take advantage of valuations in the markets. But we have been allocating to Chinese bonds, for example, China government bonds, Chinese credit in the midst of the crisis, and we see better opportunities in that region in some ways to take advantage of secular growth opportunities at reasonable valuations. On the next slide, digging in a little bit in the U.S., clearly the U.S. consumer has been one of the key drivers of not just the U.S. economy, but the global economy. And you can see, that consumer confidence, which has really fallen off, remains depressed, economic sentiment down, but some early evidence of improvements in personal consumption and retail sales, et cetera. And even though, in our view, the likelihood of a new fiscal package has declined, the president's executive action around unemployment assistance is leading to the likelihood that the average check for an unemployed person will be an additional check for $1,800 between now and January, and that is certainly meaningful and is likely to most of that is likely to be spent, and so you really have support on this side of the U.S. economy. At the same time, you have other increasing levels of uncertainty. In the next slide, we turn to the election. The most likely outcome, whether you look at polls or the betting sites or the betting odds, would be that Biden wins the presidency. And most likely outcome would be that the Republicans manage to hold on to the Senate. That is, in our view, likely to have a very muted impact on markets and earnings expectations, but you do have an amplified risk of the blue wave, where Biden both wins the presidency and the Democrats win the Senate. Regardless of political views on whether people view that as a positive or a negative outcome overall, we do believe that that would have an impact on earnings expectations, maybe not as much on valuations. That's more of a debatable point, but certainly I think that there's somewhere between a 5 and 15% potential impact on U.S. equities associated with that outcome, which would probably be fairly temporary. But this is another example of a source of volatility and uncertainty in the near term that we think is very, very important to be assessed. And the unfortunate passing of Judge Ginsburg over the weekend probably amplifies the partisan rancor over the next couple of months. Over the next 45 days, it decreases the chance of a fiscal stimulus package, and it's too soon to tell what the potential impact that could have on the election, other than that it's probably going to get even uglier if that's possible. So turning to the next slide, as we try and bring this all together from an economic standpoint and relate it to markets. Where are we in this crisis? The first two phases of this crisis have been remarkably rapid. The indiscriminate sell-off really, late January through about March 23rd, 24th, but pretty striking sell-off, and then an incredibly dramatic policy response, which has caused markets to rally. So where are we now? We think of this as a time for differentiation. We now have more data. We've got to face reality, engage the damage of this crisis, understand secondary effects, and really differentiate differences in mispricing relative to risk reward. And we think that there will be additional opportunities in terms of dislocations arising from here. And that really leads us to turn to the key themes, which I'll turn to Joe. Before I do, Jahangir, do you want to see if there are any questions or take a moment here?
Sorry, I haven't seen any come through just yet. So we can move to Joe. Unless I'm missing something?
Great. I'll turn it to Joe to translate this into the key themes we see, and then I'll wrap with with turning that into some very specific market views, and then we can get some questions.
Good. Thanks, Erik. I do hope everyone can see the slides. So I will talk through, as Erik mentioned, going from our macroeconomic views, shifting to themes which we feel are highly relevant, which we think should be viewed in the context of clients' overall asset allocation. The themes we identified back in March, we went through a process internally, as Erik mentioned, our senior investors across our platform in equities, fixed income, and alternatives, both liquid and private, as well as the views of the Asset Allocation Committee and the multi-asset team. So we went through a process to identify themes which we felt, regardless of which path of recovery would develop, would be relevant. So Obviously, how you would interpret those themes may be different and how you would implement them might be different, but we thought they would be very, very relevant. So even though valuations have moved very, very significantly, the markets have moved at a V-shaped recovery, we think they are all still remain incredibly relevant. So we just turn to the next page. The four themes that we identified in all of this process. The first one is, as Erik mentioned, durable income and yield. The second, regime shift in equities. Third, dislocation. And fourth, idiosyncratic ideas. So the first of those, durable income and yield. I mean, let's be very clear where we've been and where we are today. I started in the city of London back in the early 90s, and back then the dominant global bond index was the Lehman Global Ag, which of course, as you all know, is the Barclays Global Ag today. But back in 1990, that index yield was 9%. By the year 2000, that index yield was 6%. By 2010, it was 3%, and as of today, it's considerably less than 2%. So in that global aggregate index, which most of us use when we're proxying for global bonds, 31% of a global index is constituted of negative yielding bonds. So we have had obviously we've had this crisis, we've moved to this kind of zero rate world, but it is perhaps the most profound impact on markets is to be reflected in general bond markets and not necessarily in equity markets. Over the last 40 years, if you were a global aggregate bond investor, you would have got about 7% annualized return. Now, a lot of that is driven from that fall in yields year in, year out. Now, we're not in a position where that's likely to continue for very much longer. So you can argue that that's a very big challenge for investors, not least because in terms of durable income and yield, the demand has actually increased. So whether we're talking about institutional demand for income and yield, so the incredible demand for private credit over the last 5 or 6 years, driven by pension funds, intermediaries or private clients looking for retirement income, what have you. So this demand has increased significantly. Supply is definitely not anything to be happy about. Regime shift in equities. We are in a high volatility negative growth environment, perhaps moving to a high volatility, low growth environment. That's an extremely difficult segment, if you like, of the mixture of volatility and growth to be in. We have to look beyond the liquidity rally we've had over the last 5 or 6 months and really ask ourselves, how do you navigate your equity portfolio through that kind of higher volatility environment? So we feel investors really need to take a step back and think about how the equity market has changed over the last 6 months and think about how to position for the next 12, 18 months. So I'll get into that in more detail. Dislocation. Every time there's an equity market correction, you get private market investors jumping up and down saying this is a dislocation event. The truth is, dislocation is about the duration and depth of a crisis in the real economy. So obviously the real economy remains quite challenged today. Companies are re-examining their business models. Private markets may very well present the best opportunity, if you like, to exploit that dislocation. So I'll get into that in a bit more detail. Idiosyncratic ideas. Since the 70s, in fact, if you ran a balanced portfolio, 60-40 equities, bonds, your annual returns would have been 9-10%. Now, we're definitely not in that space on a forward-looking basis. So you cannot rely on traditional market betas to get you out of the hole that we're potentially in now. So it is very important for investors to think about non-traditional sources of return and alpha sources. So I'll get into that in a bit more detail as well. So maybe just turn to the next page. I'll start with income and yield. So we have had this, and as Erik mentioned, we're in phase 2 of this recovery we saw significant, phase 1 significant widening of credit spreads, phase 2 significant tightening of credit spreads. But where we are today, actually on an historical basis, it's still the case that investment grade, high yield, EMD provide decent value. So there remains a reasonable value in terms of the credit side of things. We need to recognize that in certain, terms of a zero rate environment, and you see that US, Canada, Australia, pretty much all developed markets, this is not a temporary event. Indeed, the Fed's change of policy more recently is pretty much said, we're going to allow inflation through time and we're going to allow it to overshoot. So we're not going to use interest rate policy to control that. So really, we're probably looking at 3 or 4 years of a zero, even negative rate environment. So that is fairly profound. And in many ways, that will support appetite for investors for yield. So, pension funds or insurance companies, when they're looking at investment grade debt trading, 100, 120 basis points of spread, they'll see that as reasonable value for quite some time, given the fact the alternative is not in any way attractive in terms of quality bonds. But equally so, there's increasing demand we're seeing for high yield and EMD. Spread levels there are still, from historical perspectives, reasonably attractive. You go to the next slide. We see on the next slide, and we relate this, if you like, back to the kind of UV L-shaped sort of thing. So, sort of different scenarios. From our perspective, obviously our base case is a U-shaped recovery. We think that's supportive of credit more generally. If there is no vaccine, no effective vaccine available within the next 6 months or so, at least no one that's coming with approvals down the line, you could argue that there will be more of an L-shaped sort of outcome here. So there'll be more investor appetite around what the Fed is doing. So that will support investment grade debt. If you believe in a V-shaped recovery, then it is about pushing out more to non-investment grade opportunities. One of the things that has happened that I think investors need to focus on as well is that we have had, I wouldn't say record issuance, but very strong issuance, both in investment grade and high yield markets over the last 3 to 6 months on the back of all of this. So markets were open, investment banks were very busy. And what that essentially means is that you've had a duration extension or maturity extension of debt. So companies have been able to refinance themselves, and that's hugely important. That's something that you would contrast greatly to versus the financial crisis, if you like. So companies were able to go out and finance themselves. Now, that doesn't mean their business models are robust. It just means it gives them more time and potentially delays the inevitable, but maybe it gives them more time to adjust to the new reality that we're existing or we're dealing with today. Erik did mention the necessity to perhaps look beyond certain traditional markets as well in terms of fixed income. And one of those areas is China bonds. China bonds actually produced quite a good positive return back in Q1 of this year. So obviously there's some decent state support for China bonds, but also institutional investors recognize the low correlation of China bonds to both traditional fixed income and equities. So very well supported market and behaves very differently from kind of other emerging markets. We think it's very important for investors to increasingly think about China separately from emerging markets as that economy over the next 5 or 10 years transition from an emerging to a developed market. Just the next slide, where, as I said, and maybe my initial comments were quite negative about the global ag and how things look so depressing in terms of what the kind of running yield is. But actually, if you're willing to look beyond the kind of core yield opportunities, the next slide gives you a much broader church, if you like, of yield strategies. Myself and Erik co-manage a multi-asset income strategy, which we do on a separately managed account and fund basis. But what you see here actually is if you go to specialist income sources and uncorrelated strategies, in terms of we build income portfolios, we potentially would combine 12 independent income sources. You can see that, well, actually on a historic basis, yields are still reasonable for many of these strategies. So whether you're talking about EMD, high yield, CLOs, potentially REITs and so on, they're not yielding, historic lows by any stretch of the imagination. Where if you move to the left, clearly, as I mentioned, US rates, TIPS, long duration IG are actually quite expensive on a relative basis versus, their historical 10-year averages and spreads. So we do feel it's incumbent upon investors who need to respond to that demand that I mentioned, which hasn't gone away. In fact, it's increased significantly, to think about a more comprehensive set of specialist income sources when they're thinking about building these income strategies. We do think, though, that in terms of building portfolios around income, it's about the highest income per unit of risk. So if, in many ways, think about what income sources that are available, but also think about hedging at the same time, thinking about managing downside risk. We think that's very, very important. It's not about maximizing return. As I said, it's about maximizing yield, but also yield per unit of risk. So managing the downside is very important. Moving on to the second theme, regime shift in equities. So as I mentioned, incredibly high volatility environment where vol has dropped significantly because of the efforts of fiscal and monetary authorities, but we're still in a very challenged equity market. Our basic view is that companies that are large cap, that have strong balance sheets, good cash flow, maybe sector leaders, are in a good position to weather the storm of COVID. We've already seen that, but we think that's likely to continue as a theme. So, our view is still that it's very important that investors in the equity space think about quality, not a narrow sense, not about just, franchise companies, but thinking about, as I said, companies with that level of financial flexibility, which can hold them in a good position over the next 6 or 12 months. Although obviously there's going to be a fair amount of volatility in the underlying economy. There is, and we need to recognize, a significant dispersion around sectors and factors, which we've seen really emerge over the last 6 months. So we've seen, momentum, certain quality and growth perform, very strongly, and we've seen things like value and income do very badly on a relative basis. Now, there can be some reasons for that. So, if I go to the next slide, I think this pretty much kind of highlights, the structural shift we've seen over the last 6 months, where the 5 largest companies in the US in the S&P 500 now represent about 25% or just under 25% of the market cap. Now that's a sudden jump. Now, some of that you could argue is the markets responding and reflecting the seismic shift in the business models. So, really recognizing that certain companies have business models that are robust regardless of whether you have a COVID or non-COVID situation. So these are scalable mega cap companies that just have very significant barriers to entry, and maybe the market's just reflecting all of that. But there's another way of looking as well, which says, look, maybe these companies have benefited disproportionately from COVID. And if we do get a vaccine, maybe there will be some sort of rotation of risk away from those 5 or 6 companies. So that's something that increasingly, when myself and Erik are talking to investors, it's a very topical point. So essentially, we view the equity market today as being quite narrow. And for most of my career, certainly over the last 15, 20 years, the MSCI World, about 52% has been the US. Because of this massive rally in these mega stocks in the United States, actually the MSCI World is now close to kind of 64% US. So that's a very significant shift that really investors need to think about. And on the flip side of this, as I mentioned, value and income have been left behind somewhat as factors. So our view is, if you look at the next slide, when you're reviewing your equity portfolio, we do think having a bias to quality makes sense. Large cap quality, yes, definitely. If you're more positive about a recovery from here, more of a V-shaped recovery in the underlying economy, you might be more constructive around, small cap, for instance. We do think income is important. We think we're trying to diversify to broader factors, but we do also. It's not simply a case of saying, well, these sectors have been left behind. They offer good income opportunities. You have to look a bit deeper than that. As Jahangir mentioned, just because there could be decent income available on the travel sector, for example, doesn't mean that that's a sector that deserves a very significant overweight at this point. But basically, investors need to be thinking more about the concentration risk that they may be running indirectly in their equity portfolios. Volatility monetization, we think, is important. The volatility of the markets today is trended around, it's about 25 to 35 today. So we're in an escalated volatility period. If we look back at the financial crisis, we went for 4 years after the financial crisis where volatility was quite escalated. So what happens when the market's volatility is escalated? Well, if you're an equity investor, you can buy obviously equities, and you will be subject to that volatility. But against that, you'll receive maybe a dividend yield. The dividend yield on the S&P today is only 1.7%. So really, if you're an equity investor, what you're looking for is price or earnings expansion, and maybe that'll happen. But in our view, that one of the ways that we think makes more sense in terms of being more assured about receiving the equity risk premium is just standardized put writing. So essentially, if you're willing to take equity risk, well, let's underwrite the equity market, achieve a very high monthly premium for doing so, and just hold that premium. It builds up month in, month out. Yes, there will be equity volatility, but against that volatility, you receive that very rich premium, which reflects the higher volatility in general markets. The final thing I'll talk about is thematic investing. On this, we've seen a lot more interest in kind of thematic investing, which reflects what we're all experiencing: remote working, education, telemedicine, 5G, all of these things. We think investors are getting more and more focused around strategies we think have high growth potential over the next 5 or 10 years. Dislocation, as I mentioned, I think we think dislocation is probably best to be played in private markets. It's about the duration and depth of impact in the economy. We're kind of unsure where we go to from here. A lot of small, medium-sized enterprises their situation has improved, but a lot of them will require fresh financing coming through all of this. A lot of those companies that I talked about who were able to tap the investment grade or high yield market obviously are public companies. Private companies also need refinancing. We also recognize that from a business perspective, we're going to see a lot less, IPOs or trade transactions. So it's, private equity investors will be investing for longer periods in these companies, which means that, from a distribution perspective, distributions will be less, perhaps over the next couple of years. But we do think there'll be opportunities. We think that if you go to the next slide, we think that there will, generally after a market correction, you get a significant opportunity in private markets. We saw this back in 2000, 2001. We saw it in 2009, 2010, which turned out to be pretty good vintage years. So having some flexibility, thinking about, what co-investments might come up, those, the terms of those transactions, the transparency, which will be higher given the state of affairs that we're in now, I think is very important. Also, there could be secondary buying opportunities if people want to get out of certain positions. So it should be a fairly constructive year for private markets. As we said, we think that that's probably the best place for playing dislocation. And then really the final theme, if we go on, you can skip the next page. We go on to idiosyncratic ideas. So, it's pretty much the same what I mentioned before, where if you go back to the 70s and a balanced portfolio has done kind of a 10% annual return, you don't feel that on a forward-looking basis. So, for obvious reasons, because you really don't want to start with yields where they are, and you don't want to start with equity valuations where they are. So, with that in mind, we think demand for idiosyncratic opportunities will focus really on 3 areas. First of all, non-traditional market strategies, and indeed, Jahangir mentioned one of those, insurance-linked securities, would be an example of that. I mean, obviously, underwriting weather risk is completely uncorrelated with traditional equities and bonds. That could be an opportunity for investing. I've been allocating on behalf of clients in the Middle East to that market since 2011. Average return is about 7% historically, and it's been pretty stable. The second area of demand is manager skill, or alpha. And for us, we like, market neutral strategies, global macro, short-term trading, those that really have a structurally low beta to the general market. Historically, maybe as an active manager, maybe I shouldn't say this, but historically, if you're getting a 60-40 portfolio that does, high single digits, maybe you don't need alpha. But on a forward-looking basis, when your expected returns are so much lower, I think alpha as a proportion of total return needs to be viewed as pretty essential. And then finally, we think on the idiosyncratic side of things, it's important for investors to think about inflation and think about all the things that we're talking about today. Maybe short-term deflation, but medium-term there's going to be inflation. So think about what strategies might benefit from a weaker dollar, or if as I said, the US economy at some point is allowed to run hot. So from our perspective, we think commodities will be an example, diversified commodities as a strategy that investors could look at. So the next two slides, I'm sorry, just really focus on those three areas, which I won't really talk to, but I'm going to pass it back to Erik, who'll try to bring it together. So as I said, we've talked about what we think are the macro drivers. We've talked about the themes which we think are most relevant. So let's relate that back to our views as asset allocators.
Thanks, Joe.
Great.
Erik, if I may, just before I hand back, or I don't know if you want to cover off some of your things before, or you may do it in through this question as well. So I think many of us are sitting there and listening to you and watching the markets and the valuations rising over the last 3 or 4 months, and most of us have been sitting there scratching their heads, trying to figure out what's driving all of this, given we're all still sitting at home. How does an asset allocator like you and Joe, how do you think about portfolio construction? How do you think about the forward-looking returns? And so how do you allocate? Because that's one of the things that everyone in this call does during the September, October, November budgeting process. So how do you do that this year? Given the markets have continued to run up, for most of us it seems over-exuberant. How do you come up with valuations for an asset allocation process? Now, that may be something that you're touching on in your few final messages.
Yeah, absolutely, and I think that is a good lead into the next slide, where we translate this into specific market views right there. Thank you. So I think that from a longer term basis, as Joe highlighted, our expectations are that risk-free rates will remain low. Economic growth will face headwinds. Inflation faces headwinds, and you have a very strong stimulative environment for years to come. What that leads to as an allocator on a longer term basis is an expectation of lower returns from traditional beta, lower yields from risk-free assets. We've already seen spreads tighten on the credit side. Lower economic growth and lower inflation leads to lower expected returns for equities and for inflation-sensitive assets. In that environment, lower expected returns, investors face challenging trade-offs. They can certainly reduce expected returns for their investment programs, but many investors don't have that luxury. They have required distributions or spending levels or liabilities. They can increase market risk, just take on more beta risk. And for many investors on a long-term basis, that's not what we would advise. Although from a tactical standpoint, we actually think that there will continue to be shorter-term tailwinds for risky assets, and I'll talk about that in a moment. Other tools that investors can use, they can rely on, they can take on more illiquidity risk, and that's something that we do see as an area of opportunity, and Joe highlighted that, but that has its trade-offs as well and its risks as well. And so for many investors, we're looking to balance more private markets exposure and barbell that with hedging or lower risk, highly liquid assets that will hedge against market environments. And that can lead to another tool in the toolbox, which can be using leverage or capital efficient structures. So marrying risky assets or illiquid assets with capital efficient exposures to risk-free or low risk assets. Like we still think that U.S. Treasuries have hedging attributes. 30-year Treasury yield of 145. Yes, it's low, but it could go to 40 or 50 basis points in a negative environment, and that would still be very hedging against tail risks. A final tool in the toolbox is to lean more heavily into active or uncorrelated strategies as both an additional source of expected return, but also to diversify other risks that are being taken in the portfolio to achieve that higher return or maintain expected return levels, even as expected returns are lower for traditional stocks and bond exposures. So that's how we're really engaging with clients, are around that toolbox, and there are elements of that are more strategic and elements that are more tactical. And as we translate these key themes and our current views into our portfolio positions, as we show them on this page, a number of those themes are reflected. So from a tactical standpoint, it's hard to make the case given aggregate levels of stimulus, given sentiment, which is not overly bullish, and given the almost certainty that earnings and economic growth levels will be higher a year from now than where they are now, it's hard not to, on the margin, be exposed to equities. Now, valuations in certain areas may give you pause, and they should. And so, our view is that we want to have our equity exposure in areas where we can get benefit of quality and growth, but with better valuations. And that's leading us to smaller and mid-sized companies. It's leading us to trim our exposure in large cap U.S. stocks. And we have an asset allocation committee meeting tomorrow where it looks like we may be going more underweight in U.S. large cap equities. Or we may be going from neutral to underweight in U.S. large cap equities and biasing towards small and mid cap stocks in the U.S. and also to European and Japanese stocks, but not necessarily towards emerging market equities outside of China and greater China, where we see stronger secular growth. The broader emerging markets, I think we still feel have short-term challenges. On the fixed income side, based on our views, both short-term and long-term, we're still leaning into credit. Credit spreads have tightened dramatically, but we still think there's room to go. And in a highly stimulative environment where we think we're in a longer period of low rates, low inflation, low growth, quality credit, durable income should be an important part of a structure. And then turning to alternatives, we're spending more time on taking advantage of opportunities in private markets, both dislocation opportunities, but also areas where you get better economics, so secondaries and co-investments, for example, more opportunistic strategies and more idiosyncratic strategies, such as cat bonds, such as uncorrelated active strategies, to try to both take advantage of opportunities out there, but potentially diversify other risks in the portfolio. And then our last slide just translates these themes and different scenarios into the strategies that will do well in different environments. And in that base case, as has been highlighted, an orientation towards quality on the equity side, an orientation towards taking advantage of volatility with put right and monetizing volatility. We expect vol to stay elevated for a significant period of time. Think of VIX around 30 for months to come, certainly through the U.S. presidential election. Well, if you can sell at the money protection on the U.S. equity market and capture 3% monthly premia, that's pretty attractive activity. Credit on the fixed income side, and then areas of dislocation and private markets and idiosyncratic ideas. I'll pause there. I know we have a few more questions as well.
Yeah, and so one of the questions we have is on the topic of ESG and around what do we see the shift into ESG? I'll cover that off from a client perspective, and then Erik, Joe, you can comment. So from a client perspective, if I understand this correctly, the demand for ESG has grown significantly over the last 18 to 24 months, with many of the searches and RFPs having very clear requirements, of great levels of requirement for an understanding of asset managers' ESG approaches. At Neuberger, we fundamentally believe that an integrated part of how you do your investment thesis and approach, and we've done a lot of work on this. We've actually had one of the oldest socially responsible investing strategies from about 35 years ago. We've of course been building on that over the last few years as well. That's an area that we do see continued and enormous demand, but it's important that it is not seen as being a sort of an overlay to a process, but it is an embedded part of the process. And it's not something that you exclude stocks for, but you collaborate with companies to help them improve their ESG credentials. So it's a journey. It's not deciding that things are just out at the moment. Do you see that creating bubbles, Eric, Joe, in sort of those companies that are ESG more friendly, tech, whether it be the carbon, the fossil fuel ones or tobacco getting shorted and others being added to? And what impact does that have from an investment perspective, do you think?
Well, I'll make a quick response to that. First of all, our view has been and remains that ESG considerations are simply good, part of good active management, that, considering a client's environmental, social, and governance impacts and policies, and leaning towards the companies that have better capabilities, attributes in those areas is not some kind of fad or trend or just something for do-gooders or virtue signalers. It's really just proper and good active management, and those themes are even more important after the crisis we've just gone through. And so we think that ESG will be more important in terms of consideration, but this is also active management. And so just because a company scores well from an ESG standpoint, you also have to consider that in terms of valuations, in terms of growth prospects, in terms of the longer term considerations. But to the extent that this crisis in many ways has amplified themes that were in place before the crisis, around quality growth, around the importance of long duration assets, around the beneficiaries of technological change, disruption, et cetera, I think that the ESG elements will also be reflected as an amplified trend going forward. And so I think companies that both demonstrate the benefits or the attributes of long duration true secular growth will also, many of them also demonstrate key elements of ESG, and that will be a beneficiary for those companies for years to come. I think the other element is the importance of considering ESG not just in equities, but in fixed income, in private markets, et cetera, and that will be equally important going forward.
One last question, as we're massively running over time. Joe, it'd be great to, COVID's definitely, as you mentioned earlier, or I think Eric mentioned earlier, has been quite a different impact on the emerging markets, their resilience to being able to service their international debt. Why have we not seen greater impact? I mean, most of what's going on in the EMD space is Turkey, Argentina driven, which have had their issues prior. How have we not seen a greater impact in the EMD space, and what's broadly the team's view?
Well, I mean, we're quite constructive on EMD more generally, but what I would say is that, and I think Eric kind of mentioned it, about how you have to look and almost have a recognition of where, in relation to COVID, where different economies are as well. So China, if you like, is 3 to 6 months ahead well, 3 months ahead of at least Europe, maybe 6 months ahead, maybe 6 to 9 months ahead of the US. So it's navigated well, and as an asset class, as I mentioned, it did really well in Q1, and it's holding up very well year to date. But we also need to recognize in certain emerging markets, COVID does not look very constructive. It's not good at all. For example, India, Brazil is another that these are economies that are being hit. Their medical systems are not like developed markets. Their financial flexibility isn't particularly high. We've obviously seen a couple of countries so far this year get into issues around debt levels, Lebanon and others. So there's a lot of differences within emerging markets. I mean, I suppose in reality, you can look at what the kind of yield available is on EMD and say, look, that's relatively attractive. But if ever there's a need for, or an argument for active management, it is now, because the disparity in terms of what we're seeing now between different markets is increasing. So we do need to have someone who's able to make a judgment from a sovereign perspective, and then of course going the next step and then looking at what the opportunities are in the corporate debt market as well in emerging markets. So yeah, so our view is yes, it's an attractive area. We've moved in more heavily, I suppose, into EMD over the last couple of months, but we've been quite selective in terms of our positioning.
Thank you, Erik. Thank you, Joe. Thank you, Team CFA, for hosting us, and thank you all for joining us today. I hope you've enjoyed it. If you'd like to learn more about any of the concepts, themes, strategies that Erik or Joe referenced, please feel free to reach out to us at Neuberger Berman. Thank you all, and look forward to seeing you soon. Take care. All the best.
Thank you.
Thank you.
Thank you. Bye-bye.